For more than 2 decades after World War II, exchange rates between major currencies were fixed under the Bretton Woods Agreement. When the United States suspended dollar convertibility to gold in August 1971, that fixed system began to unravel. By 1973, the major currencies were floating freely against one another, rising and falling with supply and demand. For banks, this created an enormous new business, trading foreign exchange. Daily FX transaction volumes grew rapidly throughout the early 1970s. And along with the opportunity came a new category of risk that most institutions had not yet learned to measure or manage. Bankhaus Herstatt KGaA was a private bank with roots in Cologne stretching back to 1727. By the early 1970s, it had grown into one of West Germany's larger private banks. Under the direction of its managers, the bank expanded aggressively into foreign exchange trading, accumulating speculative positions on currency movements. When the dollar and the Deutschmark moved against those positions in 1974, the bank's losses mounted rapidly. The subsequent German regulatory investigation found that Herstatt's foreign exchange losses reached roughly 470 million Deutschmarks, a sum that far exceeded the bank's capital, according to accounts published by the Bank for International Settlements. To understand why Herstatt's collapse had consequences far beyond Cologne, it helps to understand how foreign exchange transactions settled in 1974. When two banks agreed to exchange Deutschmarks for dollars, the deal had two separate legs that cleared in two separate places at two separate times. The Deutschmark leg settled in Germany during German banking hours. The dollar leg settled in New York during New York banking hours. The two payments were linked only by bilateral trust. Bank A would send its marks in the morning and then wait hours for Bank B to send dollars in return. There was no mechanism to guarantee simultaneous completion and no central counterparty to absorb the loss if one party collapsed between the two legs. On the afternoon of June 26, 1974, the West German banking regulator, the Bundesaufsichtsamt für das Kreditwesen, revoked Herstatt's banking license and ordered the bank into liquidation at 3:30 p.m. local time. West Germany was not observing summertime in 1974, placing it 5 hours ahead of New York's Eastern Daylight Time. When German regulators closed the bank, it was 10:30 in the morning in New York, with hours of banking business still ahead. In the period before the closure, many of Herstatt's counterparties had already delivered Deutschmarks in Germany, completing their side of open foreign exchange deals. They were now waiting for dollars from New York that would not arrive. Chase Manhattan Bank served as Herstatt's primary correspondent bank in New York, meaning it held Herstatt's dollar account and processed outgoing dollar payments on its behalf. When news of the German regulatory action reached New York, Chase halted all outgoing dollar payments from the Herstatt account. Banks that had already delivered Deutschmarks in Germany were left holding claims against an insolvent estate. Accounts from the period, including those published by the Federal Reserve Bank of New York and the Bank for International Settlements, described the scale of exposure as substantial and the disruption as sudden and simultaneous across multiple counterparties. The immediate consequence was a sharp pullback in interbank lending. Banks across the United States, West Germany, and the United Kingdom that had suffered losses or feared their counterparties had suffered losses began withdrawing credit lines. The foreign exchange market grew thin and erratic for several days as institutions restricted how much settlement exposure they would accept from one another. Regulators and subsequent academic accounts described the episode as a near miss for the broader interbank system, one that exposed a structural vulnerability that had been invisible while the FX market was smaller and its participants fewer. In December 1974, the governors of the central banks of the Group of 10 countries, meeting at the Bank for International Settlements in Basel, established what became known as the Basel Committee on Banking Supervision. The committee's founding mandate, as described in the BIS's own historical account, was to improve the exchange of supervisory information among member countries and to prevent national regulatory gaps from allowing losses of the Herstatt type to accumulate undetected. The initial focus was coordination and information sharing, not yet formal capital requirements. But the institutional machinery was now in place to do more. Through the late 1970s and 1980s, the Basel Committee developed its first binding framework for bank capital adequacy. The Basel Capital Accord of 1988, widely referred to as Basel I, required internationally active banks to hold capital equal to at least 8% of their risk-weighted assets. The framework was broad by later standards. It grouped assets into simple risk categories and did not fully address market risk or operational risk. But it established, for the first time, an internationally agreed minimum capital floor that all G10 member states committed to implement, a direct institutional product of the supervisory effort that the Herstatt failure had set in motion. The term Herstatt risk entered the vocabulary of banking regulators and financial economists during the 1980s and 1990s to describe a specific category of danger, the risk that one leg of a foreign exchange transaction is completed while the other is not, leaving the delivering party exposed to the full face value of the contract. A 1996 report by the Bank for International Settlements examining FX settlement practices at major global banks, found that settlement exposure for individual institutions routinely equaled or exceeded those banks' total capital. The report concluded that this exposure was systemic in scale and called on both the industry and public authorities to develop a structural solution. The solution the industry developed took years to construct. In September 2002, CLS Bank International began operations. CLS stands for Continuous Linked Settlement, and its core mechanism is payment versus payment. Both legs of a foreign exchange transaction settle simultaneously inside CLS, so neither party can be left holding a completed leg while waiting for the other. CLS is owned by a consortium of major financial institutions and supervised by the Federal Reserve as its primary regulator, according to the Federal Reserve's published description of the system. The infrastructure addresses directly the time zone gap that left Herstatt's counterparties exposed in June 1974. The regulatory framework that Herstatt helped initiate did not end with Basel I. Following the Asian financial crisis of 1997 and the global financial crisis of 2008, the Basel Committee issued revised accords that layered in more detailed risk measurement, introduced formal liquidity requirements alongside capital requirements, and established a leverage ratio to constrain overextension regardless of how assets were classified. Basel III, developed in response to the 2008 crisis and phased in over the following decade, required banks to hold higher quality capital and to maintain liquidity buffers designed to cover a 30-day period of stress, according to the BIS's published Basel III framework documents. The institutional thread connects a single afternoon in Cologne in 1974 to every subsequent layer of international banking regulation. Most people have never heard of Herstatt Bank, but its collapse left marks on the financial system that reach anyone who deposits money, borrows, or holds savings. The Basel capital standards that grew from the post-Herstatt supervisory effort set the floor for how much capital your bank must hold against the loans it makes. The CLS settlement system that opened in 2002 eliminates the time zone gap that cost counterparties so much in a single afternoon. And the principle that regulators from different countries should share information and align standards rather than compete on laxity traces directly to the committee founded in December 1974. Herstatt was a small private bank in a mid-sized German city. The structural lesson it taught reshaped global finance.